Controlling your emotions in investing is one of the most powerful skills you can develop. Yet it's also one of the hardest. Most investors don't lose money because they lack intelligence or access to information. They lose money because their emotions overpower their logic at the very moment when discipline matters most. Fear, greed, impatience, and doubt are the invisible forces that influence nearly every financial decision you make, whether you notice it or not. When a stock drops suddenly, fear tells you to sell. When a stock shoots upward, greed tells you to buy without thinking. When everyone online is talking about the next big opportunity, you feel pressured to join in. And when the market looks calm, impatience whispers that you need to take more risks. These emotions feel natural, but they are the biggest enemies of wealth building. They pull you into bad decisions, they trick you into buying high and selling low, and they make you react to short-term noise instead of long-term goals. Imagine the last time you made a financial decision that didn't feel comfortable. Maybe you panic sold during a dip. Maybe you watched your portfolio fall and felt a rush of anxiety that made you question your entire plan. Maybe a hot stock was rising fast and you felt like you were missing out, so you jumped in late. Every investor has been there. But what separates successful investors from unsuccessful ones is not perfection, it's emotional awareness. Successful investors recognize their emotions but refuse to let them dictate their actions. They understand that emotions are temporary, but the consequences of emotional decisions can last years. In 2026, markets will move faster than ever. AI-driven trading, unpredictable global events, inflation swings, technological shifts, and political decisions will create volatility that can shake even experienced investors. Without emotional control, you will be tossed around by every wave. You will feel uncertain every time the market dips, stressed every time it rises too fast, and overwhelmed by the constant flow of opinions and predictions. But if you learn to stay calm and disciplined, you become unshakable. You begin to see volatility not as a threat, but as a normal part of the journey. You stop reacting to every move and start acting based on strategy, goals, and logic. Emotional control is like an internal shield that protects your money from your worst instincts. One of the biggest emotions that destroys portfolios is fear. Fear makes you believe that temporary losses are permanent. Fear convinces you that every correction is the beginning of a crash. Fear makes you abandon positions that would have recovered if you had simply stayed patient. The market often punishes the fearful more than it punishes risk itself. When you sell out of fear, you lock in your losses and miss the recovery that follows nearly every downturn. The greatest investors gain confidence during dips because they understand that fear creates the best opportunities. But this mindset doesn't come from luck or talent. It comes from emotional mastery. Greed is just as toxic. Greed tells you that you need more, faster, and with less patience. Greed pushes you into risky plays, speculative stocks, and trends that look exciting but lack stability. Greed makes you forget your plan and chase whatever is going up today. But markets punish greed because every bubble eventually bursts. It is often the people who enter late, driven by the fear of missing out, who lose the most. The disciplined investor avoids this trap by remembering that wealth is built slowly, steadily, and intentionally. Not by luck, not by hype, not by chasing someone else's excitement. Another emotion that destroys wealth is impatience. In a world where everything is instant, we expect investing to be instant too. But investing is the opposite of instant gratification. It rewards those who wait, those who endure, those who allow compounding to work at its own pace. When you're impatient, you jump between strategies, you abandon long-term plans, and you look for quick profits. But real wealth is not created through quick wins. It's created through consistent, patient, long-term investing. Emotional discipline reminds you that great results require great patience. Then there's the pressure from other people. The markets aren't the only source of emotional confusion. Friends, influencers, videos, news headlines, and social media all create noise that affects how you feel about your investments. When you hear that everyone is buying something, you feel left out. When you hear that a crash is coming, you feel anxious. When you see someone claim massive profits, you feel behind. All of this is emotional manipulation, even if it's unintentional. If you react to this noise, your portfolio becomes a reflection of other people's opinions instead of your own goals. Emotional control helps silence the noise so you can focus on what actually matters. Mastering your emotions starts with understanding your plan. When you know your goals, your timeline, and your strategy, you gain clarity, and clarity weakens emotional impulses. If your goal is long-term wealth, then short-term drops don't bother you. If your strategy is consistent investing, then market noise loses its power. If your timeline is decades, then temporary losses feel insignificant. Emotional panic often exists because there is no clear plan guiding your decisions. A strong plan creates emotional stability. Another key to emotional control is understanding yourself. Know your risk tolerance. Know how much volatility you can handle. Know what type of investments truly align with your comfort level. Many investors take risks they aren't actually comfortable with. And when those risks go wrong, emotional panic takes over. By aligning your investments with who you really are, not who you wish you were, you reduce emotional stress and improve your consistency. The final stage of emotional mastery is learning to pause. When markets move fast, your instinct is to react fast. But the best investors pause. They breathe. They observe. They think. They remind themselves of the bigger picture. They wait for clarity. This pause is powerful because it breaks the emotional loop. Emotions demand action, but wisdom demands patience. That pause can save you from panic selling, chasing hype, or making decisions you regret later. The market rewards the patient far more than it rewards the emotional. In the end, emotional control is not just a financial skill, it is a life skill. The market will challenge your discipline, test your patience, and push your emotions to the edge. But every moment you stay calm, every time you choose logic over fear, every time you stick to your strategy despite the noise, you become a stronger, smarter, more confident investor. Emotional mastery is the foundation of financial mastery. It is the invisible work that creates visible results. It is the quiet discipline behind every long-term success story. And once you learn to control your emotions, the market no longer controls your wealth. You said expand keynote number 2 into 1,000 words without any headings and ending sentences. ChatGPT said, "Brr. Ignoring the hype and staying loyal to your strategy is one of the gray." Test strengths you can develop as an investor, especially in a world where information spreads faster than ever and opinions are louder than facts. Everywhere you look, someone is telling you what to buy, what to sell, what's going to the moon, and what's crashing next. The noise never stops. It's relentless, persuasive, emotional, and often completely disconnected from the principles that genuinely build wealth. When you follow hype, you lose control of your financial decisions. But when you stay loyal to your own strategy, you reclaim that control and move with clarity, purpose, and confidence no matter what the crowd is doing. Think about how many people lose money every year simply because they followed excitement, not research, not logic, not principles, just excitement. A stock shoots up and suddenly everyone wants in. A new technology trend appears and everyone wants a piece of it. A big influencer posts a chart and suddenly people feel pressured to act immediately. This is not investing, it's reacting. It's emotional decision-making disguised as opportunity. And while hype can make you feel like you're catching the next big wave, most of the time you're catching the wave at its highest point, right before it crashes. Hype pushes you into a mindset where you stop thinking long-term and start thinking in moments. You begin chasing what looks good today, forgetting that true wealth is built through patience, consistency, and discipline. The crowd rarely makes decisions for the long game. Hype encourages shortcuts, and shortcuts rarely lead anywhere meaningful in investing. If you observe the most successful investors in history, they don't chase trends. They don't run after whatever is popular at the moment. They stick to principles, strategies, and frameworks that align with their goals, regardless of what others are doing. When you stay loyal to your strategy, you stop looking for validation from others. You stop comparing your portfolio to someone else's gains. You stop feeling like you're missing out. Instead, you move with confidence in the direction you've chosen because that direction is specifically aligned with your personal risk tolerance, your financial goals, your timeline, and your understanding of the market. Your strategy becomes your anchor. It keeps you steady when the waves of hype and noise crash against you. The core issue with hype is that it blinds you to risks. When something is trending, it's easy to overlook fundamentals, valuations, business models, and long-term sustainability. You don't pause to ask the most important questions. Does this fit my plan? Is this business actually strong? Am I making this decision because it's wise or because it's emotional? Hype convinces people to skip their homework. It convinces them that research is unnecessary because everyone else is doing it. But the market does not reward shortcuts. It rewards knowledge, preparation, patience, and perspective. One of the biggest psychological traps linked to hype is the fear of missing out. FOMO makes you believe that if you don't act immediately, you will lose a once-in-a-lifetime opportunity. This emotion creates urgency where none actually exists. It pushes you into rushed decisions that don't reflect your actual goals. But here's the truth that experienced investors understand: opportunities are endless. There will always be more chances to invest, more companies to study, more cycles to ride. You don't miss opportunities by avoiding hype. You miss opportunities by abandoning your long-term strategy. Your strategy exists for a reason. It protects you from impulsive behavior. It reminds you of the bigger picture. It guides your decisions so you don't react to every piece of news, every viral post, every sudden price movement. A strong strategy reflects your personal goals. Maybe you're investing for retirement. Maybe you want to build wealth for your children. Maybe you want financial freedom or long-term stability. Whatever your goals are, hype does not care about them, but your strategy does. When you stick to your plan, you honor your goals. You protect your future self. Staying loyal to your strategy doesn't mean you ignore new opportunities. It means you evaluate them through the lens of your plan. It means you don't jump in blindly. You consider how an investment fits into your overall picture. You review the fundamentals. You consider the risks. You think long-term instead of acting on impulse. This behavior transforms you from a reactive investor into a strategic one, and strategic investors are the ones who thrive over decades. Another reason hype is dangerous is that it creates unrealistic expectations. When you buy something because it's trending, you expect quick profits. You expect big gains. You expect the excitement to last forever. But markets don't work that way. Trends fade, excitement fades, prices correct, and when reality hits, many investors panic because they were never prepared for volatility in the first place. A disciplined strategy, however, accepts volatility as part of the journey. It expects ups and downs. It is built to survive uncertainty. When your expectations are aligned with reality, you don't panic. You stay confident. You stay focused. Loyalty to your strategy builds emotional resilience. When prices fall, you don't collapse with them. When prices rise, you don't abandon your plan out of greed. You stay balanced, grounded, and intentional. You act based on logic rather than emotion. This resilience is what separates successful investors from the rest. It allows you to endure market cycles that others fear. It allows you to make decisions that align with your financial future rather than the market's temporary noise. Imagine how many investors bought something because it was hyped, only to regret it months later. Imagine how many lost sleep over decisions made in moments of excitement or fear. Imagine how many could have avoided losses if they had simply followed their own strategy instead of the crowd. You don't have to be one of them. You can choose clarity over noise. You can choose discipline over impulse. You can choose long-term vision over short-term excitement. Your strategy is not just a plan. It is your identity as an investor. It is the roadmap that leads you to your financial goals. It keeps you focused on what truly matters: steady growth, smart decisions, and long-term wealth. You are not here to follow the crowd. You are here to build your future. And when you ignore the hype and stay loyal to your strategy, you gain something far more valuable than quick profits. You gain control, wisdom, and the confidence to navigate any market environment with calm strength and unwavering purpose. You said, expand keynote number 3 into 1,000 words without any headings and ending sentences. ChatGPT said, diversification and consistency are two of the most powerful forces in long-term wealth building, yet most investors underestimate their importance. Many people think investing is about finding that one golden stock or timing the perfect moment, but true wealth is built quietly, steadily, through the discipline of spreading risk and contributing regularly. Diversification protects you when things go wrong, and consistency rewards you when things go right. Together, they create a foundation strong enough to withstand market crashes, global uncertainty, and emotional ups and downs. These two principles don't just grow your money. They protect your future, your peace of mind, and your long-term financial confidence. Diversification is the art of not putting all your hopes, dreams, and money into one place. It doesn't matter how promising a single stock or sector seems. No investment is perfect, and no market stays stable forever. Companies change, industries collapse, trends fade, and unexpected events can shift the market in seconds. A portfolio built around one or two big bets is a portfolio built on uncertainty. Diversification turns uncertainty into stability. By spreading your investments across different sectors, asset classes, and opportunities, you create a safety net that protects you when the unexpected happens. If one area struggles, another can support you. If one stock falls, another may rise. If a sector collapses, your entire portfolio doesn't collapse with it. This balance is what keeps long-term investors alive through every market cycle. People often avoid diversification because they believe their favorite pick will outperform everything else. This mindset is tempting but dangerous. Every year, thousands of investors watch their guaranteed winners crumble because they underestimated how unpredictable the market truly is. No one can control global events. No one can control industry disruptions. No one can control sudden technological shifts, political changes, regulatory decisions, or unexpected market corrections. Diversification isn't about being unsure, it's about being wise. It is a recognition that the future is uncertain. And the smartest way to protect your wealth is by spreading it. Even the world's greatest investors, Warren Buffett, Ray Dalio, Charlie Munger, advocate diversification not because they lack confidence, but because they understand risk better than anyone else. On the other side of wealth building is consistency. Consistency means investing regularly, whether the market is rising, falling, or standing still. It means committing to a habit rather than chasing moments. Most investors fail not because they lack knowledge, but because they lack consistency. They invest when they feel excited and stop when they feel scared. They invest when the market looks promising and freeze when it looks dangerous. But true financial growth requires the opposite. It requires investing even when the environment feels uncertain, even when fear whispers doubts, even when others hesitate. Consistency is what transforms small contributions into large results. Every dollar invested becomes a seed. And the more seeds you plant over time, the larger your financial forest grows. Many people wait for the perfect time to invest, but the perfect time almost never comes. Markets move unpredictably. News shifts daily. Economic cycles come and go. If you wait for the perfect moment, you end up waiting forever. Consistency eliminates this problem by turning investing into a habit instead of a decision. When you invest consistently, monthly, weekly, or based on a schedule, you remove emotion from the equation. You no longer ask whether the market looks good today. You simply follow your plan, and your plan works because it is built on time, not timing. Over years and decades, consistency allows you to benefit from dollar cost averaging, which means you buy at different prices, smoothing out your costs and reducing risk naturally. This approach doesn't just build wealth, it builds resilience. The combination of diversification and consistency creates something powerful: stability. Stability in your mindset, your portfolio, your financial future. A diversified portfolio that you contribute to consistently can survive recessions, crashes, inflation, and uncertainty. It keeps growing quietly in the background while you focus on your life. You no longer panic during downturns because you know your portfolio is balanced. You no longer obsess over short-term movements because your long-term habits are stronger than temporary noise. This is what separates long-term investors from emotional traders. Traders chase excitement. Investors build wealth. Imagine investing $100 a month for years without fail. Imagine spreading it across different types of stocks, ETFs, bonds, and assets. Imagine watching that small monthly commitment grow slowly at first, then faster as compounding takes over. One day you look back and realize that the fortune before you wasn't built by luck or timing. It was built by consistency. It was built by the quiet discipline of showing up. This is why consistency is more powerful than intensity. Most people try to invest intensely, waiting for the one moment to go all in. But intensity comes and goes. Motivation comes and goes. Market cycles come and go. Consistency stays. Consistency compounds. Consistency wins. And diversification supports that consistency by making the journey easier. When your portfolio is well balanced, you're far less likely to panic during downturns. You don't feel the urge to abandon investing when one stock falls because you know your money is spread safely. Diversification protects your confidence. It protects your emotions. It protects your long-term vision. You remain invested during rough times because your risk is balanced. You remain patient because your system is stable. Without diversification, consistency becomes harder to maintain. Without consistency, diversification cannot reach its full potential. The two principles feed each other, support each other, and strengthen each other. Both of these principles also protect you from yourself. The human mind naturally wants quick results and simple answers. Diversification forces you to spread out instead of making impulsive bets. Consistency forces you to invest regularly instead of chasing trends. Together, they create a disciplined structure that guides your behavior and prevents emotional mistakes. You don't have to predict the market. You don't have to beat the market. You simply have to participate in the market in a smart, consistent way. Diversification also allows your portfolio to benefit from different opportunities at different times. One year, technology might soar. Another year, energy might lead. Another year, real estate might outperform. If you are diversified, you win not by guessing which sector will perform, but by owning a mix that ensures you benefit no matter which sector leads. This makes your returns smoother, your volatility lower, and your growth steadier. And when you combine this with consistent investing, you keep adding fuel to the fire. Consistency also builds discipline. Every month you invest, you reinforce your identity as a long-term investor. You become more patient, you become more logical, you become more confident in your plan. You stop reacting to the market because your habits are stronger than your emotions. Habits grow wealth. Emotional reactions destroy it. Each time you invest consistently, you choose discipline over impulse, order over chaos, long-term vision over short-term fear. In the long run, these two principles, simple yet powerful, shape your financial destiny. They transform chaotic markets into manageable pathways. They turn uncertainty into opportunity. They create wealth even when the world feels unstable. And they give you the peace of mind that comes from knowing your future is not left to chance, but built through steady, intentional, and diversified decisions. You said, expand keynote number 4 into 1,000 words without any headings and ending sentences. ChatGPT said, bar. Understanding what you own is one of the most underrated superpowers in investing. Yet it is the difference between staying calm when the market shakes and losing everything because fear took over. When you deeply understand your investments, why you bought them, what drives their value, how they make money, and what their long-term potential truly is. You no longer react emotionally to every sudden dip or every loud headline. You stop seeing the market as a daily scoreboard and start seeing it as a long journey where temporary turbulence doesn't define the destination. Most people panic because they don't know what they own. They buy something because a friend mentioned it, because a YouTuber hyped it, because it appeared in trending news, or simply because the price was rising. They don't know the business model. They don't understand the risks. They haven't studied the financials, and they certainly don't know how to measure the company's strength beyond surface level excitement. So when the price drops, fear arrives immediately, and they run because they don't have any solid foundation beneath their decision. But when you understand what you own, your entire investing psychology changes. Instead of reacting to fear, you respond with confidence. Instead of getting scared by dips, you interpret them as discounts. Instead of shaking with uncertainty, you patiently hold because your decisions are grounded in knowledge and clarity. Understanding what you own means knowing the story behind your investment. It means knowing what problem the company solves and how it earns money. It means understanding whether it has a competitive advantage, whether the management is competent, whether the financial health is strong, and whether the long-term direction aligns with your investment goals. When you do this, every movement in price stops affecting your emotional state. You know why you're invested, so market noise becomes irrelevant. You begin to appreciate that volatility is not a signal to run. It is a normal part of the journey that doesn't alter the company's actual value. Many new investors confuse price with value. They focus on the daily up and down movements, thinking those fluctuations represent real changes in the company's worth. But price is only the market's short-term opinion, often driven by emotion, hype, or panic. Value is what the business is truly worth based on earnings, growth potential, competitive strength, and financial stability. When you understand value, you stop worshiping price. You stop checking your portfolio 5 times a day. You stop caring about temporary dips because you know the actual story hasn't changed. And if the story hasn't changed, then the long-term potential hasn't changed either. Understanding what you own also protects you from the dangerous habit of copying others. Too many investors follow influencers, friends, or strangers online who claim they found the next big stock. The problem is you can borrow Mione's idea, but you cannot borrow their conviction. When the stock drops and fear hits, you won't have the knowledge to hold because you never understood the investment in the first place. That's why copying without understanding almost always ends in losses. Your decisions become dependent on external voices instead of your own research. But when you build your own conviction through understanding, you become independent. You stop leaning on others and start trusting your own analysis. That's when you shift from being a follower to becoming a real investor. This level of understanding also helps you stay patient, because patience is impossible without clarity. If you don't understand what you own, Every market correction feels like danger. But if you do understand it, corrections feel normal, even expected. You know that even great companies face temporary challenges. You know that even strong stocks experience volatility. You know that price dips don't destroy long-term potential. So instead of panicking, you remain calm. Instead of selling out of fear, you wait. Instead of abandoning your plan, you strengthen it. This calmness is the biggest advantage you can have over the market, because most people panic. Most people react emotionally. Most people sell at the worst time. But the investor who understands what they own can think clearly during chaos. That clarity allows you to benefit when others make emotional mistakes. Understanding what you own also helps you identify opportunities instead of threats. When you see a strong company drop in price due to temporary news or general market fear, you don't panic, you get excited. You recognize that the company's long-term fundamentals remain solid, and this dip is simply the market offering you a better entry point. Most investors fear red days. The informed investor sees them as the market going on sale. This mind's T-shift can only happen when you understand what you own at a deep level. Without that understanding, every dip feels like danger. But with understanding, dips feel like opportunities to build wealth at a discount. There's also a psychological strength that emerges when you understand what you own. You stop obsessing over short-term performance. You stop worrying about what others are doing. You stop seeking constant reassurance. Understanding brings confidence, and confidence brings discipline. When you have discipline, you stay committed to your long-term plan even when the market tests your patience. You become the kind of investor who isn't easily swayed, who doesn't chase trends, who doesn't panic sell, and who doesn't abandon a great investment because of short-term noise. This is how real wealth is built, not through reacting emotionally, but through acting intelligently. And the beautiful thing is that understanding what you own is not something reserved for experts. Anyone can do it. Anyone can learn to read a company's story, study financials, evaluate risks, and form an informed opinion. Anyone can take the time to understand before buying. It doesn't require genius, it requires effort. And that effort pays off because it protects your money, strengthens your mindset, and transforms your investing journey from stressful to strategic. Understanding what you own is how you build conviction. It's how you stay calm. It's how you resist panic. It's how you separate yourself from the crowd and step into the category of disciplined, confident, long-term investors. It's how you stop letting the market push you around and start letting knowledge guide your decisions. Understanding what you own is the foundation of every great investor's success. You said, expand keynote number 5 into 1,000 words without any headings and ending sentences. ChatGPT said, burr, avoiding the urge to time the market and trusting long-term compounding is one of the greatest decisions an investor can make, because it frees you from the exhausting cycle of trying to predict what no one can consistently predict. Timing the market may sound exciting, like a game where you jump in at the perfect low and cash out at the perfect high. But in reality, it becomes a trap that destroys both wealth and peace of mind. You spend your days guessing instead of investing, reacting instead of planning, chasing instead of building. And the truth is, even the smartest professionals with decades of experience and advanced tools cannot reliably time the market. If they cannot do it with all their resources, why do individual investors think they can do it with emotion-driven instincts and social media predictions? The market does not reward guesswork. It rewards patience. It rewards discipline. It rewards those who understand that wealth grows through time in the market, not timing the market. When you stop trying to predict the ups and downs and instead commit to staying invested, you unlock the true power of compounding. Compounding is quiet. It is slow at first, almost invisible. But given enough time, it becomes the single greatest engine of wealth creation. Every small return earns its own return, and those earnings earn returns too, forming a chain reaction of growth that accelerates with every year that passes. Most people underestimate compounding because they expect quick results. They want fast profits. They want instant wins. They want the excitement of guessing right. Compounding asks for patience instead. It asks you to allow time to do what short-term thinking never can. It turns tiny daily growth into massive long-term wealth, but only for those who stay invested long enough to experience its magic. Trying to time the market forces you to make two nearly impossible decisions: when to get out and when to get back in. Getting one of them right is rare. Getting both right consistently is impossible. Most people get it wrong. They sell when fear is highest, usually near the bottom, and then wait too long to re-enter, usually after prices have already recovered. They miss the strongest days of the market because those days often come right after the worst ones. And missing just a handful of the best days can drastically cut long-term returns. That is what timing the market steals from you, your chance to benefit from the big upswings that create long-term wealth. But when you stay invested, you never miss those days. You ride through the waves and catch the big jumps that often come when no one expects them. Trusting long-term compounding also shifts your mindset from chasing quick wins to building real wealth. Wealth is not built through sudden spikes. It is built through consistent growth. It is built through holding strong investments and allowing them to mature. It is built through understanding that time, not timing, is your most powerful investing partner. Even legendary investors like Warren Buffett will tell you that their wealth did not come from extraordinary genius. It came from staying invested for decade after decade. The real miracle was not the strategy, it was the duration. The longer you stay invested, the more compounding accelerates. And the more it accelerates, the harder it becomes to lose money over the long run. Avoiding the urge to time the market protects you from emotional decisions. When you try to time the market, you become a prisoner of your feelings. You feel fear when prices fall, so you rush to sell. You feel excitement when prices rise, so you chase the trend. You follow emotions instead of logic. But when you commit to long-term compounding, your emotions lose their power. You no longer panic during dips because you understand that dips are temporary. You no longer chase spikes because you understand that spikes are unpredictable. You no longer let fear or greed dictate your decisions. Instead, you let time and discipline lead the way. Emotions become noise and patience becomes your guide. Trusting compounding also helps you appreciate that the market doesn't need to be predicted. It only needs to be participated in. The market rewards those who stay steady through storms because storms pass. It rewards those who remain calm during volatility because volatility creates opportunity. It rewards those who focus on decades, not days. When you shift your perspective from short-term results to long-term progress, the ups and downs no longer shake you. You begin to see the market as a long-term machine that trends upward through innovation, growth, and human progress. You begin to see corrections as natural, not catastrophic. You begin to see staying invested as an act of confidence in the future. The beauty of long-term compounding is that it does not require perfect decisions. It does not require predicting the next crash. It does not require knowing when the next rally will start. All it requires is commitment. Even average investments held for long periods can outperform brilliant short-term trades. Even moderate returns compounded consistently can grow into something extraordinary. Compounding rewards consistency far more than cleverness. It rewards those who how up every year, not those who try to win every moment. When you stop timing the market, you stop treating investing like gambling. You stop relying on luck. You stop chasing the illusion of perfect timing and instead embrace the reality of steady progress. You trade short-term uncertainty for long-term confidence. You trade emotional stress for financial growth. You trade guesswork for a proven strategy that has built wealth for generations. Long-term compounding also gives you the freedom to think clearly about your financial future. Instead of constantly adjusting your portfolio based on emotions, you can build a plan and follow it. Instead of monitoring the market daily, you can trust your process. Instead of fearing the next downturn, you can be prepared for it. Predicting the future becomes unnecessary when you know that time itself is your greatest ally. The more you invest consistently, the more compounding works for you in the background, quietly and powerfully. You don't have to chase it. You only have to allow it. Avoiding market timing also reinforces your discipline. Discipline is what separates the investor who panics from the investor who thrives. Discipline means holding when others sell, buying when others fear, and staying calm when others stress. It means trusting your plan more than the noise around you. And discipline becomes easier when you commit to long-term compounding, because you know that the real prize is not today's price movement, but the wealth that accumulates over years and decades. Long-term compounding transforms investing from a stressful guessing game into a peaceful, strategic journey. It teaches you that wealth is built not by being right all the time, but by staying invested long enough for the market to work in your favor. It shows you that the true win is not catching the perfect moment, but avoiding the destructive habit, trying to guess it. It reminds you that the most powerful force in investing is not prediction, but patience, not speed, but steadiness, not luck, but longevity.